You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, listeners, you know what that music means. It's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding Options Insider Radio Network. A lot of great places for you to find all of the programs on this network, including Volatility Views. Of course, you can do it in iTunes, Stitcher, AHA, Mobile, TuneIn, our website, of course, the Options Insider, the website of all of our legions of network partners, as well as in our brand new mobile app available for iOS, Android, and Amazon Fire OS. Of course, you can instantly stream through the app all of your favorite episodes of Volatility Views. That's 100 plus now, listeners. So there's some serious listening, some great guests in that archive. You really should check it out if you're a new listener to the program. And of course, while you're doing that, if you say, hey, I want to save a few of these, listen to these later on my trip or on my commute, you can do that, download them for offline listening. And while you're listening to the show, you hit that feedback, that contact, that email tab there. You can, of course, shoot us an email through the app. You can shoot us a Facebook question, a Twitter question. You can even leave us a voicemail all through the app. No shortage of ways to have your voices, your questions, your comments heard on the old Volatility Views program. All right, and joining me on the Volatility Views program this week, my cohorts, my partners in crime, starting off with the man beaming in from the great state, nay, the empire known as Maine, none other than the Rock Lobster himself, Mr. Andrew Giovinazzi from OptionPit.com. Mr. G, welcome back to the program, sir.
Always good to be on the Volatility Views on a lovely Friday afternoon in Maine.
This is our version of The View here on the old network. All we're missing is our Barbara Walter surrogate and maybe a Rosie O'Donnell or two, and we're good to go. Is there any volatility gossip you can think of we can hit on the show?
Any vol gossip? I don't know. We'll have to read the mail. Maybe as our listeners tune in, maybe we can get us some juicy mail gossip, some kind of news possibly in the gossip zone.
There you go. A new segment for the show, the Vol Rumor Mill, the Vol Gossip Mill. How about that? I like it.
We could create some, I think. We could create some decent volatility gossip.
You see who Robert Whaley was seen with last night?
I know, exactly. Well, I think we're going to talk about him possibly, right?
Yes, he may come up in the show a little bit. And speaking of hot, juicy volatility gossip, when you think of that, you certainly think of our next co-host, none other than Jared Woodard, the founder of the former Condor Options and now the research major domo over there at BGC Partners. Jared, welcome back to the show. I'm glad you can break away from your TMZ lifestyle for a few minutes to join us here on the program.
You will not believe what the CME thought about Whaley. No. Yeah, I'm glad to be here. We're talking about vol and views, and I have those, and I think there's a lot of good stuff to cover today.
Yeah, we've been off for a week, listeners, due to the holiday here in the States, so we have a lot of stuff to cover. So without further ado, let's do it. Let's dive right on into our volatility review segment.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, listeners, this is, of course, the Volatility Review segment, the portion of the show where we break down the week, or in this case, the weeks that were from a volatility perspective. We are recording this on Friday, listeners, July 11th, so bear that in mind if you're playing the home game there. And as we're recording this, it's bringing to an end a very interesting, tumultuous week in the world of volatility. And again, a bit of a quiet end to that week. Most of the major indices essentially unched on the day. Q's catching a little bit of a bid, but that's really about it. S&P and Dow pretty much unched on the day. VIX cash coming off a little bit, and this marks the tail end of a pretty interesting, pretty tumultuous week from a volatility perspective. The VIX was all over the place. The VIX cash vacillating around quite a bit. It had quite a range, over 2 points, 2.25 points roughly. Got down earlier in the week to about right around the 11 handle, 11.01 or so, just threatening to break through into the 10 handle again. And then, of course, all the tumult of this week happened. Portugal, etc., all the concerns coming out of Europe sent the market into a bit of a tizzy, and the VIX shooting north. We had several days where it gapped up 12, 13%. Actually, no, I'm sorry. Gapped up about 8% one day and even more another day to the total. So, for this week's range, about 11.01 on the downside, up to about 13.25 on the upside. So about a 2.25 handle range this week in the VIX cash. And as the week comes to a close, we're hovering right dead in the middle of that range. So like you said, Jared, a lot to parse in there. We've been off for a few weeks, and this past week, certainly no shortage of volatility topics, no shortage of actual movements from a volatility perspective. So we'll start there. What caught your eye in the week that was with all of the vol action? What really resonated to you this week, Jared?
Well, so all year people have been complaining about markets not moving and nothing really happening, and how they were longing for the days of some moderate volatility. And it was interesting just on chats with people and on the stream and Twitter and around this week, when you did start to see a little bit of movement in the indexes. We came really close to having a 1% move in the S&P, and people weren't just like, as thrilled as maybe you thought they would be, given all that special pleading throughout the year.
You're right. People were lamenting pretty much all year long, or at least for the last quarter. VIX is too low. Nothing's going on. There's no realized vol in the marketplace. As a result, there's no implied vol. There's nothing worth trading. I can't sell. I can't harvest any premium. There's no juice for me here. It's not worth doing anything, yet the upside is still bid up, so I can't buy protection. Blah, 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 blah. All these endless things. We finally see some movement to offset that and get some juices flowing again, and people just aren't happy regardless. Andrew, I know you've been busy chatting it up this week over there at the Options Insider branded pit chat, I might say. I see you've adopted that name, so we'll expect our check forthwith. But what caught your eye, and indeed, what caught the eye of your many mentees and clients over there in the week that was from a vol perspective?
I don't know. We had a little bit of kind of black swan stuff, which was looking like it was going to explode into something beautiful yesterday on the opening. And just as I was trying to put some, get out some unwind orders, the market just went right back the other way. It literally was like, okay, 1%, we'll look around. Nothing's really changed. Portugal's just some dopey little country anyway, and whatever. That was it. Like, wait a minute. Whatever happened to the good old Euro crisis? So, one thing about like resilient or bull markets is, when vol spikes, all the spikes have been, I was just looking at it this year, just anytime we get any kind of news, the vol spike seems to just not quite get anywhere. They don't make the highs that they were before. Maybe that is just statistical, that the lower the volatility is, when you're starting at 11 vol and it goes to, almost 13, I think we just went across 13. I guess statistically on a percentage basis, that's a pretty good jump, right? But, holy guacamole, man. It's just they could not get the volatility stayed above 13 for about 20 seconds. So, we had a couple of pops the last few months, even coming, but we can't get above it. We can't just make this move. So, to me, when I see stuff like that, I'm like, it feels like the market could still go higher just because the recovery from any kind of bad news is just ridiculously fast. Unless it's a real structural problem that people are picking up, they came in and just saw it as another opportunity to whack out some puts, and vol came right back in again. So I have to say, I wouldn't be surprised if we saw volatility in the 11 handle next week or lower again. So, but we've been kind of playing this, with types of trades that are, slightly short realized vol and owning some kind of black swan protection trades of that nature, being careful where and how you kind of generate any positive theta. But, some kind of good old fashioned trades where you're long some options tend to be working out okay too. So I think it's the short, like sort of the short gamut trades that people kept selling Russell Iron Condors and things that were kind of relatively dependable. When the vol gets this low, you just don't get the same amount of money for them as you used to. So it's harder to make them work, and then the market decides to move. So it's not an easy environment, but it feels like at the same time, that deep downside move it feels like it keeps getting taken off the table every week that goes by. And that's kind of what I feel about what's going on now.
Yeah, we saw those market increases in vol, but you're right. They were very short-lived this week, even looking at some of the realized vol numbers with S&P flying around all over the place midweek. The realized vol didn't even really tick up too much. I think we got up to in the 10-day out there in the SPX to about 8% earlier this week, right at the start of the week, and then it kind of just filtered off from there, hovering around 7 the rest of the week. 20-day it about got as low as 6 even. So, yeah, you're right. It seemed like there was a spark of life. Seemed like there was a lot of concern. We did see some sell-off in the broad market, but you're right. It seemed like that was just an opportunity for people to essentially sell some puts and take advantage of whatever little life they could find in volatility. I guess they're all following the Bill Gross model of just sell all vol in all markets at all times. So far, at least, that strategy is not exactly working out too poorly.
No, I looked at, like, I was looking to add to some, like, Yahoo positions and stuff like that. I'm like, well, okay, whatever.
Yeah, I've been thinking about that this year that what's the most painful, most unpleasant trade for people to do? Because that's usually the kind of thing that works, right? And this year, it just seems like the last thing anybody wanted to do was to sell premium when it's at nominally low levels. Just like you're saying, Andrew, it's unpleasant, and that's exactly what's continued to work this summer. Even selling a VIX straddle when it's low and you're exposed, it's like it's worked, and it's one of the few things that has worked.
Yeah, of course, with these sharp spikes up we saw earlier in the week in VIX, of course, that got a lot of attention in the broad media. A lot of people writing up. I know this drives you crazy, Andrew, but writing about how it gapped 16% in one day. And I know how it drives you mad to hear 1% of 1%, but c'est la vie. That seems to be the nomenclature everyone has adopted these days. So why buck the tide? There's so many other battles to fight. Pick your battle, sir. But they mentioned it hasn't gapped up as high as we saw earlier this week. It's 16%, I believe it was, since at least April. So a lot of people were hanging their hats on that. A lot of people were also hoping that the start of earnings season, which kicked off this week, would perhaps spark a little bit of life back into the market, give us a little bit of juice, a little bit of vol. And so far, that hasn't really materialized. A lot of research reports are coming out earlier this week saying people were expecting the vol to return as a result of earnings. People were preparing to the upside as a result of that. And yet, so far, at least, like we said earlier, that wasn't exactly the best trade we saw all week. Moving on here to the VIX options activity that we saw. That's, of course, the way a lot of you hopefully are playing the VIX and indeed in the futures and not playing around in some of those crazy ETFs and ETNs that we'll get into in a little bit. VIX options, again, lighten up the tape this week. No surprise there. Open interest now at a whopping 9.24 million contracts. That's above the average levels even we've seen out there in open interest of late, which are hovering around 8.6 million. So another 600,000 or so contracts essentially open out there in VIX of late. So just ridiculous numbers any way you look at them out there in VIX land these days. This product is just on fire. Of course, again, we touched on in the past, looking at that open interest and parsing it a bit. We've hit on many times that the calls are very, very much outnumbering the puts. And a lot of people got up in arms, I think it was a few weeks ago, when it got into the 3.4 to 1 range. Bloomberg was writing about it, saying that was at historic levels. This is crazy. Well, now we're well beyond that. We're at 3.7 to 1. So, again, as we talked about before on the show, it's structurally, it kind of makes sense where we are right now at these levels in the VIX. But still, these are pretty historic levels any way you cut it. Again, so you can look at that a lot of different ways. People prepping for a lot of upside. People just systemically being forced into upside strikes because there are fewer downside strikes. A lot of ways to parse that, but either way, those numbers are getting pretty crazy. We did see some interesting trades out here this week as well in the VIX options. We'll start it off at the beginning of the week. That's, of course, when a lot of the craziness started ensuing back on the 8th. We saw a very, very sizable trade going up, actually, on the 8th to kick off the week from a VIX options perspective. Someone came in and gobbled up just a ton of the July 13 puts. These are things that are going out fairly soon, listeners. So very, very near-term bet to the tune of 144,000 of these puts, to be precise. And then he financed some of that by selling an upside 16-20 call spread. I think he net paid 82 cents for the whole thing. So the call spread taking off some of that, but not all of that. So this guy prepping on some very, very near-term declines here in the VIX. That kind of goes against what we've been saying for a while, that all the activity is indeed upside. And at least from a strike perspective, that trade hasn't been too bad so far. Also going up on earlier this week. Oh, we saw some pretty interesting. Saw some call spread. Looks like call spread rolls out there. Someone selling out a July 14-20 call spread, rolling it out to August, a little bit tighter, Aug 14-18. Doing that fairly substantially, fairly sizable as well. Selling out about 22,000 of that July call spread to buy 33,000 of the Aug. Usually you see it the other way. Usually you see it close out more and then buy less because it's going to be usually more expensive to buy that. But again, he did a tighter spread, so maybe he took advantage of that to save some premium. And then moving on to more recently, yesterday, we saw essentially just a flurry of trades again. One of the larger ones we saw yesterday was a 10,000 lot of, looks like, I guess you can call it a time risk reversal, or essentially what it really is buying some longer term calls, some SEP 15s for $1.29, went up about 10,000 times. And to finance that, he sold some nearer term puts, some AUG 13 puts to be precise. 13 strike is where the action is these days. 13 puts are where the action is. He sold those out for $1 and change, so netted about 28 cents on that spread. And if he does that again in September, he actually could pay for all of the premium of that upside call trade there in VIX. So that's some of the big things we saw from a VIX options perspective. The open interest positions, the active strikes that we're keeping an eye on out there, changing up a little bit to the tune of the July 16s leading the charge this week. All these numbers, though, down substantially from what they were 2 weeks ago on the show, which they were in the 400,000 range. Even though the open interest numbers net have increased overall for VIX, some of these high top strikes are down substantially, including the July 16s, only 307,000 open. That's off from, I believe it was the July 14 puts recently, the 13 puts that were over 400,000 open. The July 17 calls, number 2, with about 300,000 as well. And then dropping on down from there, SEP 19 calls, still, I believe, part of that big spread we highlighted a month or so ago. And then the July 13 puts, again, that strike, lighten up the tape, no small part thanks to that giant, massive amount of puts we saw going up earlier this week, about 262,000 open on that strike as well, and then rallying on down. All of it pretty much July until you get to the number 8 spot with the SEP 20 calls for 220,000 roughly of those open as well. So a lot of paper going up out there in the VIX options land. Andrew, any of that catch your eye this week?
We looked at a little VIX this week. Mostly, I think at this point, this part of the cycle, maybe we look to game the July future a little bit. But, you know, all people are doing is buying calls. So that to me means it's kind of hedge marketville. So realistically, I mean, what does that mean, right? People are buying lots of upside and they're staying long, and it feels like that's going to be a lot of VIX premium that's going to get burned, to be honest. But it's not super surprising that people keep piling in to buy it, because they're looking at the last 5 years and they're not understanding the last 20. So it'll be interesting to see what happens to the upside in there if we have another 6 months of this type of trading, where we only see 1 or 2 spikes above 13. But like I said, people are buying lots of insurance because I think they want to stay long. So, and that gives them a reason. It keeps them from having to bail. So it's probably healthy that people are buying lots of insurance as opposed to the old days in 2011 when they were selling it at the first hint of everything. So that's kind of where we are. It's a market that's going up, and it doesn't feel like it's going to collapse anytime soon, which I think is a big mental sea change from what everybody's had over the last, probably from 2009 till the beginning of this year. Everybody's looking for the next shoe to drop, and it hasn't quite dropped. I read something funny about in the Wall Street Journal, and it seems like it, but the market cycles are generally around 10 years. That's about how long it takes for one generation to forget what's going on, and then you have some new generation that has come in that's only seen a bull market, and they forget because they just think everything goes up, and they can't make any mistakes, and then and then all of a sudden it doesn't quite work out as well as they think. So, and I think that's kind of where we are right now. We're sort of in the middle of that right now.
Yeah, in terms of hedging flow, I think there's been a little bit of a shift from people taking a default approach to looking at the VIX or to other volatility products. And now, given how, the kind of the churn that we've seen and how difficult it seems to get any real traction in the form of sustained volatility, it seems like people have been defaulting a little bit more towards sort of traditional index products if they want to put on a hedge, whether it's the Spiders or SPX or, Qs or something like that, rather than going to VIX products. And that's just anecdotal in terms of the desk flow that we've seen lately, but I think it's an interesting move, and it does make a lot of sense.
No, I agree. There has been a lot of interesting activity out there in S&P, SPX land as well. We'll get to that in 1 second. I want to just jump on to the other VIX options product that's been lighting it up of late. Is, of course, VXXT. These are the short-term VIX options. We've kind of been collectively waiting for this product to light fire, to catch fire and take off in the marketplace. And it was hovering around some relatively paltry levels of open interest for a substantial amount of time. 1,000, maybe a couple of thousand contracts open. Seems like the activity over the past week really seemed to juice that up a bit. We're seeing open interest levels out there now, at least, that are 3x, even 4x what we were seeing out there. Nearly 7,000 contracts open out there right now. That may sound nominal compared to the mothership of VIX with over 9 million, but still brand new product, and it seems like it's finally getting its sea legs underneath it. If you're looking at the call to put again, like we see in the big mothership VIX, talk about call heavy. No one wants anything to do with puts out here in VXST. It is all calls all the time, about 8-to-1 calls to puts out here. Again, most VIX products typically call heavy anyway. These go in the extra mile. When it's a week or less, nobody wants to touch a VIX put apparently, except for that one guy who bought 140,000 of the Julys. That was essentially a weekly trade too, but interesting stuff here. Looking at the open interest positions, the strikes that are lighting it up, seems like most of the action right now is on the near term expiring next week in July. The 22 calls, that's where the biggest open interest chunk is, about 3,005 contracts. And then the next big strike is the July 14 halves, again expiring the same time, about 1,500 open to those, and 1,000 of the July 19 calls. Again, call heavy all day long, listeners. 1,000 open to those, and then we drop substantially from there. Actually, some puts finding their way into the mix. The July 10 puts, so substantially out of the money puts at this point. 550 of those open as well. And those pretty much were all brand new paper very recently this week as well. So that at least makes a liar of me. One guy out there is playing in puts in VXXT, and he bought 550 of them to be precise. But that's really about it. The rest of the positions drifting off from there. But still nice to see some life finally trickling into VXST. We were watching it into non-farms. We were watching into a lot of events that would seem like they would be the catalyst to make that product catch fire, and yet it didn't. And now, for whatever reason, Portugal apparently was it. I don't know why Portugal was the thing, but c'est la vie. That's what finally had this product. We'll see if this open interest stays or if this is just a blip. If it drops back down to like 2,000 again next week, then we'll see that this was kind of a near-term blip. But hopefully this is the sign that this product is starting to catch some life here, catch some fire here with the trading public. And Jared, you were just talking about what's going up in SPX. A lot of people are looking at the primary index products versus the vol products this week. And that seems to have been du jour for a while now. We've been talking, a lot of the broad media has been talking a lot as well about the skew. I think you touched on it in recent episodes as well, how the skew was getting fairly steep out there. And it continues to be pretty interesting out there from that perspective. So yeah, that of course being a big driver. A lot of indexes still disseminated off of that. SIBO, of course, disseminating their skew index. It's hit some interesting levels, even though they use a very obtuse nomenclature to quote that index. What's your take on the current levels we're seeing right now out there in SPX skew there, Jared? Is it still as markedly steep as it was last time we talked 2 weeks ago, or has it come off a little bit?
I think we were hitting some really extreme levels in a number of indexes, especially if you look out at smoother data like 3-month options using like the last 2 or 3 years of data. You had some pretty extreme readings in not just the S&P, but the Dow, I think the Diamonds ETF, and then some of the equity indexes in Europe were kind of the same place in terms of percentile ranks of where the skew was. So this was a really widespread phenomenon, kind of intuitive, I think, to me, that people are want to maybe take some profits in the form of selling calls, maybe use that to hedge with puts, maybe not. But yeah, we've seen pretty extreme readings lately. I think those moderated a bit this week with the bit of a sell-off we saw in the market, people taking profits on some of the puts that they had. But those levels are still overall pretty high.
Now, speaking of those high levels, we had a reader send in an interesting link. It was recently, so we didn't have a chance to get to it till just this week, discussing some interesting analysis of exactly that, of looking at the sharply steep level of skew out in products like SPX, of course, indicating both a little bit of near-term anxiety that we're reaching some perhaps frothy levels in the market people want to hedge, but also, of course, indicating that they are indeed hedged because they're buying those puts, which can, of course, be a contrary indicator, paving the way for more bullish activity to come. But the interesting thing about that was they were comparing that level of skew versus what we're seeing out in the VIX. They call it, there's various nomenclature for this as well, skew versus VIX ratio. And this can get a little bit obtuse as well, because now you're talking about how do you quote skew versus how do you quote the VIX and what levels. I suppose the traditional way is that 25 delta or total net 50 delta risk reversal, and then comparing those levels of volatility versus what we're seeing out there in VIX. It's a pretty interesting indicator. One of the more interesting ways I think you can use VIX as an indicator versus what we're seeing in the SPX. I know, Jared, you have a legion of indicators incorporated in those models you guys are running over there at BGC. Is this one you guys regularly flag, the ratio of SPX skew to the VIX? No.
I mean, there's something to me that's a little bit, I don't know, lacking in intuition about that ratio. I've seen it one or two places over the last couple of weeks, and I mean, those two indexes measure some meaningfully different things sometimes. And so, I mean, it's kind of like how you can plot anything in terms of gold, the price of gold, or, anything in terms of the price of any other thing, and sometimes achieve really fantastic results. But if you don't have some guiding intuition as to why those things are related or in what way they're related, it's hard to draw really meaningful conclusions. So in terms of the ratio of VIX to the skew index, I guess I'd at the very least need more of a story behind that.
That's kind of my initial problem with that as well, is that this is definitely one of those ratios, one of those numbers, one of those stats that you could twist in a lot of interesting ways, depending on how you quote it and the nomenclature you're using, because there really is no standardization for it whatsoever. So you could quote it in a lot of crazy ways, and then all of a sudden, oh, look, the VIX to skew ratio is extremely abnormal. I think it's an interesting idea. I think it's something I would like to see maybe talked about more, and maybe some a little bit more standardization coming into how this is measured. Obviously, skew is typically that 25 delta call, 25 delta put in the risk reversal, and looking at that. But how do you compare that to straight up VIX? Are you talking just straight up VIX level? Are you talking about implied vol of the VIX, even the skew of the VIX, which is a whole other conversation for another day? But there's a lot of different ways you could compare and contrast the two, and I think you could draw very different conclusions as a result. So I can kind of understand why perhaps you're not leaning on this as your primary indicator on the research desk there, Jared. But still interesting stuff. I love when our readers send in these more esoteric things because it always gives us fodder to talk about here on the show and food for thought for you guys at home as well. We haven't been on in a couple of weeks, and the story broke right after we recorded our last show. I want to make sure we got it on this time. For all of you out there who think we here on the Volatility Views program are unfairly maligning quality products like VXX and TVIX and all these other things out there that we've pretty much referred to as garbage many times on this program, let you know that we are not alone. Just a few weeks ago, right after we recorded our last episode, the folks over there at the Wall Street Journal, our good friend Chris Dietrich over there, who writes a lot of their option stuff, sat down with Robert Whaley. Of course, if you don't know him, he is indeed the inventor of the VIX. And he said pretty much the exact same thing that we've been saying on this program from day one, which is that those products are garbage. He, of course, now is a professor over there at Vanderbilt. And he said that these indexes of VIX futures, he said the indexes of VIX futures that these volatility-linked ETFs track are much less sensitive than the VIX itself. He says people want VIX, but they simply aren't getting it. They're getting a muted version of it. Again, something we've been beating the drum on this program for quite a while. And he also went on to say VIX ETPs do not appear to provide insurance. Investors are much better off selling these products rather than buying them. And he goes into what we've said a lot of time as well on the show because of the contango trap in these products. Of course, the funds buying a lot of longer-term futures, and because they rebalance on such a frequent basis, selling nearer-term vol, and it just disadvantages them very dramatically over the lifespan of that product. So interesting stuff. It's nice to see that the creator of the VIX is finally getting into this fray. His product has been twisted and changed and altered and played with and discussed in many ways, probably far beyond the initial viewpoint, the initial construction this product was intended to be. So it's nice to see that he's finally jumping in, at least, and weighing in on some of these products that are really, I think, hurting a lot of retail investors out there. Andrew, I know you've called VXX many things, including predictably crappy. Are you surprised that the quote-unquote father of the VIX is finally weighing in on these things and tossing them on the garbage heap?
Well, I'm glad that he is. I actually met him once and had lunch with him. He's certainly a super nice guy. Probably got a lot of things on his plate, but there are a lot of things out there that are securitized that are crappy. I mean, you got to get realistic. A lot of stuff is securitized and sold, like maybe over-the-counter exotic strips from mortgages that aren't going to make their interest payment this year. I mean. There's no shortage of products that are junky. The most important thing about any product is understanding how they work. And just like Mr. Professor Whaley said there, investors would be better just selling these products than buying them. So is it a speculative product? Yes. Is the VIX a speculative product? Yes, you can use it for speculation or you can use it for insurance. There's all different kinds of ways to use it. I'm glad he did weigh in on it. But like I wrote there, I'm shocked. I'm shocked that there's gambling in this establishment. Just totally shocked that there is a product that is put out there that, nobody really understands exactly how it works. But some people do. So for all of our listeners on the Vol Views, it's one of my favorite products to trade because it is so dependable. If they took that product away, I'd have to go find something else. So, for his point of view, there's a lot. I don't think it's a great product for a buy and hold investor. They're looking for something different. So in that case, I'm more in the two-saw realm of you want to have apples to apples, no pun intended for him, when you're trying to hedge a product. So, but I'm glad would be interesting is how they're going to improve it. You know, how do you buy a future? How do you buy a decaying asset? It's like really ultimately when you think about it, it's like buying an option with a lot of premium in it. I mean, yeah, it can work. You could buy it, but what does most of the public do with options? They sell them. You know, they sell them to professionals who go out and figure out how to pay for the decay. So, you know, on that stretch, the way the VIX is designed, it's very, very hard to get away from the decay part. Now, there's lots of clever ways to get around it, which we teach at Option Pit. But for the most part, that decay is just part of the price to ride. So as long as you know it going in, you should be okay. But if you trade it and then learn about it afterward, that generally isn't the right order of doing things as far as I have learned and taught, you know, over the last few years here.
Now that's an easy fix, though, Andrew. You just create a VIX physical, then you go out and buy a barrel of VIX, and then you put it in a warehouse somewhere, and then you just create an ETF trust off of that barrel of VIX holdings, and you're done. No worry about contango anymore. There you go.
It's no problem. It's you put it right next to the barrel of monkeys.
I have 2 barrels of VIX in my office right now. It's good stuff.
And they're right next to a barrel of monkeys, and somehow it's all going to work.
Jared, what's your take on Whaley diving into the fray here and his take on VXX and all these fun products?
Man, thank you for that perfect segue, because that's exactly what Whaley essentially claims to be doing in the second half of that piece. First, I have to say big congrats to Chris for that kind of scoop. I mean, outside of our little realm of options traders and volatility watchers, you know, I don't know that article had the kind of impact that we might be giving it, but at least in our world, I think it was huge, and I think it was notable, and you know, props to him for that work. But what Whaley did there was, I think, just really shocking, and I'm sure he's a fantastic guy, done really great work, but just within the scope of this one specific set of quotes, I think it was definitely something people should go back and take another look at, not just because of the points Andrew made, which were, I agree with all of that 100%. I mean, for someone to come out and say, I can't believe that options would incur a cost associated with the passage of time is just, it's like, it would be like if a bond investor said, oh, I can't believe that this thing is going to converge to par at maturity. I mean, what is this roll down you speak of? You know, it's just, it's so funny, really, ultimately, to see somebody expressing, yeah, right, like they're shocked that options decay over time and that, you know, there's going to be contango associated with that. I mean, on the one hand, I can understand where he's coming from, and this is a question that we get almost every week, where someone, you know, focuses on the cost of carry, essentially, is what it is, of holding these positions. But to talk about it as a kind of a flaw or a defect or a problem or something to be solved, to me, just expresses a fundamental misunderstanding of the nature of markets, not just volatility or options, but of markets at all. I mean, there's the time value of money and the cost of carry and other sort of fundamental laws that sort of drive the way that our markets work. And if you don't understand those costs and those features, then yeah, you're going to have unpleasant surprises. And I think in the case of VIX instruments, people have clearly not carried over knowledge that they have maybe from other areas of the market to this area. And so they do become surprised that VIX futures have a cost of carry, that there is a time value of money, just like there is with options. And I don't know why there's a disconnect in that way, but it still seems to persist. And I think that that's what Whaley's tapping into and what he's trying to address. So on that level, I can understand the frustration perhaps or the desire to make that point. But at the same time, anyone who's not just sophisticated, but who has a little bit of experience with these products understands that these are not flaws. They're not sort of something that you could repair or undo or anything like that. And then sort of to come and compound that error by saying, well, here's this product that fixes all of these quote unquote flaws that I'm going to come out and endorse on top of all of these criticisms, just kind of smells funny. I mean, it's a weird thing for someone to do. I'm not a lawyer. I don't know, you know, the regulatory requirements on ETF issuers and all that kind of stuff. And I certainly wouldn't make any accusations in that direction. But just at the level of perception, I think it's a very weird signal to send that here are these quote unquote flaws that we have now somehow magically managed to fix. And for my money, I hope that the AccuShares products do fantastically well. I think they're fascinating, and I hope they succeed with full sort of genuineness on my part. But I don't understand how they're going to, or how they're going to achieve the kind of things that Whaley seems to be claiming on their behalf.
Yes, that is indeed a good point. He has, of course, he's not just out there speaking for the edification of the retail investor. He's also, of course, has a bit of a vested interest in this game now, recently having signed on as a partner over there at AccuShares, which is, of course, creating this new, I was joking before about a barrel of VIX, but it kind of is analogous to what they're trying to do over there at AccuShares, essentially creating a product that tries to find some way around this contango issue that has been flummoxing a lot of VIX traders for quite some time. So yeah, indeed, he's not just out there for the goodness of his own, to unburden his conscience. He really is has an axe to grind in this, as a lot of people do these days. But interesting nonetheless. That made a lot of headlines in a lot of different places, and so worth discussing here on the old Vol Views. All right, moving on to a couple other things here in the old Vol Review before we make some time for your questions. And it was some interesting other data coming out this week, including some data from our friends over there at JP Morgan. Not to quote another researcher there, Jared, but there are a few others floating around out there. And he did some interesting analysis of the correlation between the high cap U.S. stocks and what levels we're looking at now, and how, of course, that correlates to broad volatility in the marketplace. And as a general rule of thumb, typically when vol is high, those correlations are high. Things are moving around. Things are gapping alongside each other. And when vol is low, those correlations are starting to get a little bit low. And as people have been saying for quite a while now, vol is quote-unquote low. So not surprisingly, these correlations are starting to drift ever downward. And they graphed it out with some interesting things. They threw in the Great Depression. They threw in the Cuban Missile Crisis, the 87 crash, of course, long-term capital, all that stuff, 2008. Those, of course, being the spikes of correlation, because, of course, those were also the periods of spikes of great volatility. And now, if you look at this, that's one downside of doing radio, listeners. It's kind of hard for you to see this chart. But if you surf on over to Business Insider, this article, you can see this chart for yourself. It discusses how over the last 88 years of different crises in the market and how the correlation has shaped up. It's a very interesting chart, and we are right now, listeners, essentially to summarize it for you, right in the, I suppose you can call it, the lower end, if not the middle trough. Not at historical lows, certainly. There have been much lower levels of correlation over time, including during the OPEC crisis and during the mid-60s there. But right now, we are at the lower end of that trough. I guess you can call it the middle to lower end of correlation. Is this another indicator you guys look at over there at BGC, Jared?
Oh, sure. Correlation of any kind, implied, realized, what have you. This is, I think, something that people have been looking for 1, maybe 2 years, ever since the financial crisis. We've seen low implied vol, but implied correlations have been frustratingly kind of high. And we're seeing an uptick in interest in single stock names and individual industries and sectors, more so than, I can say for sure, than in recent years. But even with that anecdotal interest, there's still quite a high implied correlation in a number of places. The CBOE has indexes on this, and those have been they still kind of refuse to move down to pre-crisis levels, which suggests that something is still maybe fundamentally a bit different.
Yeah, interesting stuff. I think that chart, unfortunately, like I said, hard to convey on the radio, but that chart really caught my eye because you're right, the correlation levels haven't perhaps been dropping as you would expect, given everything else we've been seeing in the broad macro volatility environment. So this chart kind of puts all that in some interesting perspective for people. All right. We can keep going on, listeners. We want to make sure you guys get your time on the old Vol Views panel as well. So we're going to keep on rolling right on into the Volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the Volatility voicemail. Make your voice heard by dialing 779-669-4VOL. posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, listeners, welcome to the Volatility Voicemail. This is, of course, the portion of the show where you guys get your chance to join us here, make your questions, your comments, your insights known. Starting off with Morgan Shebanek. Hope I'm pronouncing that right. Shebanek. He writes, ow. He starts off his comment with ow in big letters and exclamation points there, listeners. So he just downloaded the mobile app. Wasn't referring to that, thankfully. He writes, pretty nifty, even if it is redundant, as all pertinent episodes are automatically put in my podcast queue. Just as an aside, listeners, that is an interesting point. Of course, we really designed the mobile app for the Android folks because there's a lot of fragmentation in that space. Very difficult to have one platform to get all the shows on. iTunes, obviously, is built into all the iOS devices, so it makes it much easier. So we wouldn't be offended if you guys you like to use iTunes as well, but the app kind of puts it all in one place. So we decided once we made it for Android, you had to make it for everybody else too. So you all get a version. A lot of people on iOS do like it and are using it, but if you decide to use podcasts instead, we won't hold it against you. He goes on to write, I enjoyed the latest episode, and yes, I can attest as to the accuracy and the timeliness of your vol call. As a retail investor who has a couple of regular accounts but no futures trading capability, I have a question. So I want to utilize a trade on vol. Okay, what the heck am I supposed to use? TVIX and VXX, they look like terrible products. VXST, can't trade it. The options are listed, but when I tried to trade, no go. Ook. So I feel like I'm left using puts on SPY or Qs, maybe some RVX at the small caps that look like they are going to roll, but I digress. Please help me find the proper product. I am not looking to hedge, but rather playing a, quote, trade in vol when I feel the timing is correct. Thanks for all the mad knowledge. Keep it up, Morgan. Great question here. A lot of questions in here, Morgan, touching on a lot of themes we've touched on many times on the show in the past, just recently today, talking about VXX and how garbage they are. And yes, I think we all would agree, except for Andrew's use case of when you want it to drop, and he likes to use VXX in that scenario. And if you understand the limitations of VXX and use it for a short-term trade, it can be viable. But what you want here is you want to actually look like you want to spec probably to the upside, I would wager, in which case, VXX not really your product here. You mentioned, ironically, you don't mention the VIX options, which I think would be one of my first choices for you. You mentioned TVIX, VXX, and VXST. VXST also, like I mentioned today, getting a little bit more volume. So I would this email came in a little over a week ago, so maybe I would go back and check that out again because it might be a little tighter, a little bit more viable than it was even a couple of weeks ago. But I would say your first look should definitely be to the VIX options. I'm not sure why you don't futures trading capability. That would probably be it.
He could trade VIX options. I mean, he could still, even though there's a zero edge in it, but like trades that work, you could sell puts or ratio put spreads in VIX, especially when you're down around this level. That might help finance some upside, although of course that trade is done to death. So they've pounded any edge out of that particular type trade. Butterflies are pretty cheap in the VIX. Especially, it just again depends on where, but you could have really, really, really wide skewed butterflies in the VIX. Looking at if you want to just trade the physical product, you don't need a future account to trade VIX options, though. You just do it right from your straight up account, as far as I know.
Yeah, some brokers get a little iffy with that,
I guess it is going to depend on what your broker is. I just don't have a problem with it.
And if you do try to trade from a futures account, I know you do have to have securities and a securities account to trade VIX options along with it. So essentially, to trade VIX futures and options, I think you have to have both, really, which makes it suboptimal for anyone who has just one or the other. But that's the regulator's fault, not the brokers.
Right. So that the problem is, do you want to hold a regular? Now, one of the things that might work well is a product XIV, which you can buy or short depending on what you want. So, shorting XIV, that's kind of an inverse VXX product. Normally, XIV, if VXX goes down forever, XIV goes up forever. You might want to take a look at it. But it's a good way to have volatility exposure in an ETF. You just have to use it sort of backwards. So how I have a lot of clients that use it hugely successfully is when vol spikes, they end up buying XIV as a short vol trade. And when vol's super cheap, they try to find ways to short it. So there's no options on it. And again, depending on your broker, you have to look at availability. Like I said, you start trading a product like that, you've got to understand it, because if vol does spike huge, XIV will go into the ash can. I believe it was trading around in 2012 in the Euro crisis. I think it traded below $5. And right now, I think it's around 46 or 7 or something like that. So again, it's a different vol product. It, as crappy as VXX is, reliably crappy, XIV works reliably well, but it is a short vol product there's no ifs, ands, or buts about it. It's a short vol product. So you have to be very careful and understand how the product works, which of course is what we have Option Pit for in the Gold class, and all these ways of educating people on how all this stuff actually works together.
Jared, what's your take here for Mr. What was his name? Mr. Shabanik.
Hey, there's nothing wrong with plain vanilla equity index products at all. If you were trading in the early 90s and all you had to work with was like spiders and maybe you could trade diamonds and IWM and the Qs, I think you can do 90% of what any person would really ultimately need to do. Yeah, Andrew. Oh, yes. I mean, the sophistication that we talk about here is really interesting, and there's some cool strategies. But I think the vast majority of use cases for hedging, plain vanilla equity index options are sufficient. And especially, I mean, we were talking about this at the top of the show, when volatility is having a hard time getting traction anyway, and the economy is looking as good as it is. I think that the equity index products might be more attractive here for a while. In any case, no matter what your access question might be. So I don't think that's a huge thing to get upset over or spend too much time thinking about. And the nice thing with the equity index products is that you can get that directional move, even if you don't get your volatility side of things exactly right. If you're going to be a serious volatility trader, then getting account permissions and the right kind of brokerage stuff set up is obviously important. So I guess it really just ultimately depends on what specifically you're trying to accomplish.
Yes, all good stuff there. Certainly, I'm not sure where he got the impression that we were disparaging, direct type trades. In fact, I think it's probably the opposite on this show. We've quite often gone in favor of using an SPX put or something like that, as opposed to using VIX as a quote unquote hedge or trading like that. So we definitely lean in favor of using direct products. There's certainly no reason why you should be ashamed or not use something like what did he write? So I'm left using puts on SPY. That's not a bad thing. SPY is a pretty good vehicle, and as a volatility trading vehicle, it can be very useful as well. So I wouldn't really immediately dismiss that. And certainly, if you can trade things like VXST options and RVX, you can certainly trade VIX options. I don't know why you wouldn't want to go that route as well, some sort of mitigated premium, mitigated outlay, risk mitigated type spread, like a vertical spread or something like that in VIX options. It'd certainly be a good way to go. And if you want to go the non-option variety, you can certainly go Andrew's way as well with XIV. No shortage of ways for you to play vol out there, Morgan, regardless of what kind of account you have. And usually, like I said, it is a little bit of a gray area. Some brokers get a little fuzzy with needing to have a futures account to trade VIX. Usually you probably shouldn't have to, but some brokers get a little iffy with that stuff. So I guess it sounds like you're saying your broker says no, but on the other hand, you can trade VXST and RVX. So sounds like you have some wiggle room there, which is worthwhile. A great question, as always. Unfortunately, that's all the time we have for the old volatility voicemail. Now we're going to keep on rolling right on into our final segment. It's time for the Crystal Ball segment.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the Crystal Ball.
All right, everybody, welcome to the Crystal Ball segment. This is, of course, the portion of the show where we prognosticate wildly, recklessly, with just complete abandon for the week to come from a vol perspective. And when I think of reckless prognostication, I, of course, think first of good old Mr. Jared Woodard. of BGC Partners. Jared, what are you looking at for the coming week across any broad suite of vol products? The floor is yours, sir.
Can I say more of the same? I mean, the data is good. The Fed is really keeping perceptions in check and gradually becoming less transparent in just the nuanced kind of way that we want. So it's hard to call for any kind of change in the tone of things. I think if anything, the biggest thing on my radar for this summer is whether we're going to see any uptick in wages and wage growth and inflation, which I'm skeptical of. But we'll get more data on that at the end of July. In the meantime, things are looking good, and exogenous little 1 or 2 day shocks like we saw this week are probably good for selling premium. With that said, I think there's a lot more interesting things happening in individual stocks and individual stories, and there's a whole host of interesting things going on at that level that, frankly, we haven't been able to do for the last few years. So I think there's the wide open opportunity at the level of individual industries and companies.
Andrew, the floor is yours, sir. Prognosticate wildly.
It's hard to follow up the king of reckless prognostication. I don't know how you really do that, actually. But, if nothing happens this weekend, I feel like just looking at VXX and VIX today, you've got a day where you have VIX down a little bit. But there was so much taken out of volatility futures yesterday and the day before relative to cash. It feels like the vol products can't go down until really VIX goes down pretty hard. If you don't see another shoe dropping this weekend, we probably might see the south of the 11 handle by Wednesday for VIX, especially if a couple more earnings come out. I know they didn't like the Wells Fargo a lot, but they seem to be okay, even though the market didn't like it too much. But again, it's not whether it's really good or bad, it's whether it moves the market up or down a lot. And today's news, let's see. Let's ring in here what this huge move is today. As I look, the SPY is up 9 cents. Okay, all I can say is that generally does not move the realized volatility needle very much. So, as Jared said, probably more of the same without a shoe dropping. Probably see the 10 handle this week sooner rather than later in VIX if, any kind of earnings are halfway decent. So that's what we got.
All right, good stuff as usual, guys. Unfortunately, that's all the time we have for the Crystal Ball segments. Also, all the time we have for this episode of Volatility Views. But before we go, as always, let me check in with each of these crazy compadres here on the old Volatility Views panel. See what they have cooking that may interest you. Starting off with you, Jared. What's coming down the pike from BGC Partners?
Well, we just put out today, actually, a little bit longer piece titled Third Quarter Event Gamma, where we're looking at a few different risk scenarios that the market might not have fully priced in yet, and some trades and hedges to go along with those. One has to do with second quarter earnings and whether those might come in better than expected. We look at wage growth, like I mentioned, food price inflation and the drought in California, the sort of political dysfunction and stagnant Congress, and especially the export-import bank scenario, and then some geopolitical stuff around the world at the tail end. So just a whole grab bag of interesting scenarios and ideas. And then next week we're looking at more on buybacks. There's a real fascinating story with the Dow and the convertible preferreds they issued. So lots and lots of cool stuff coming along.
And Mr. Andrew, what's coming down the pike over there at the pit?
Wow, that is cool stuff, Jared. Anyway, we're going to have our option boot camp, quarterly boot camp, where you get lots of options. If you like this show, if you like the option block, if you like understanding about how options work, this is your best chance to get some learning on for a reasonable price. The boot camp's from August 13th to the 16th. It's about 2 hours a day. Basically gives you a little window into Option Pit, the services that we provide all our clients on a daily basis, plus all that good old-fashioned education and learning. Again, surf on over to Option Pit /events and check it out. Send me a note, Andrew@optionpit.com, and I will be happy to give you at least a 10% discount if you say you listen to it here on the Option Insider Radio Network. Andrew@optionpit.com, and I would be happy to give you a discount on it. The boot camp is limited to the first 200, and after that, we will shut it down. So let us know. It is from August 13th through the 16th.
Yes, tell Andrew you want to get your learning on, and then you'll get all sorts of discounts. Maybe he'll send you a nice grammar textbook while he's at it as well.
Exactly. A Strunken White will be included with you.
All right, that's going to do it for this episode of Volatility Views. On behalf of Jared and Andrew and, of course, myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, downloading the app, all the fun things you guys do every day, as well as for sending in such great questions. Only got to one of them this week, but there's a lot more in the hopper for future episodes, so keep sending them in. We love to see them. We read them all, and even get a chance to answer them all on the air. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.